Hello. Hello. So we are now starting with module 9 analysis of income taxes. Differences between tax laws and financial accounting standards results in difference between accounting profits, that is income before taxes on income statement, and taxable income as per the tax laws in the given jurisdiction. These differences can either be temporary or permanent. If it is a temporary difference, which means that expense is allowed as deduction in 1 year, or the amount that is allowed as an expense is different in tax, which will be subsequently allowed, then it will create deferred tax asset and liabilities on the balance sheet and are important for capturing income tax effect for all the current period activities. Even if the tax consequences occurs in future, current and deferred tax expenses are used to calculate the effective tax rate, which is used by analysts in estimating after-tax profitability measures like free cash flow. Given temporary and permanent differences, the ETR typically differs from the statutory and cash tax rates for the issuers. Example, let's say if the statutory tax rate is 17%, your deferred tax plus your current tax or your effective tax rate will not necessarily be 17% because there will be certain expense which are not allowed as deduction for tax purposes, which is a permanent difference, or certain category of income which is never taxable, which is again because of maybe tax holiday or because of the legislation's statute. This always creates a permanent difference. So what is going to be the learning module overview? Accounting profit is reported on company's income statement in accordance with the prevailing accounting standards and not as per the Income Tax Act. Uh, the company's taxable income is its income subject to income tax under the tax laws of the relevant jurisdiction and is the basis of income tax payable, which appears on the balance sheet. Taxable and deductible temporary differences reverses in future period, while permanent difference does not. Deferred tax assets and liabilities arise from temporary difference in accounting profit. Deferred tax assets represent taxes which have been paid but that not yet been recognized on income statement, and deferred tax liabilities occurs when financial accounting income tax expenses is greater than the regulatory income tax expense. You have already provided for liability that would be paid in future. The changes in deferred tax assets and liabilities are added to your income tax payable to determine the company's income tax expense, which is your profit after the item of your profit before tax. Three type of tax rates are relevant to analysis: statutory tax rate, effective tax rate, and cash tax rate. The actual amount of cash tax outflow, which appears in your cash flows after the income from operating activities, is considered as a cash tax rate. The statutory rate of that jurisdiction is the statutory tax rate, and your current tax plus deferred tax divided by PBT is your effective tax rate. Companies present and disclose income tax related information through income statements, balance sheet, and notes. Companies will disclose how the income tax provisions were derived from the US federal statutory rate in the income tax disclosure. Companies will provide detailed information about the derivation of deferred tax assets and deferred tax liabilities. Company's accounting profit is PBT. Its taxable income is the amount that is subject to income tax. Income tax, the company's taxable income is the basis for its income tax payable or recover an asset which appears in the balance sheet. Income tax paid is the income tax paid is in a period is the cash amount paid for income and reduces the income tax payable. The tax base of the asset or liability is the amount at which asset or liability is valued for tax purposes, whereas the carrying amount is the amount at which assets or liabilities is recorded in the financial statement. The tax basis and carrying amount of assets and liabilities can differ based on differences in accounting standards and relevant tax laws. Common differences are as follows. Revenue and expenses may be recognized in one period for accounting purposes and in different period for tax purposes. Let's say if there is a pre-incorporation expense, it will be expensed, let's say in the books, but for tax purposes, it may be divided over the period of initial 5 years or 10 years. Specific revenue and expenses may either be recognized for accounting purposes and not at all for tax purposes or vice versa. Subject to tax rules, the tax losses in prior year might be used to reduce the taxable income in the later years, resulting in difference in accounting and taxable income, which is your tax carry forward. Adjustment of reported financial data from prior years might not be recognized. Adjustment of reported financial data from prior years might not be recognized equally for accounting and tax purposes or might be recognized in different periods. Taxable temporary difference. The taxable temporary difference results from carrying amount of assets exceeding its tax base, like the aforementioned accelerated depreciation example for year one, or when tax base or the liability exceeds its carried value, is a result of is the recognition of deferred tax liability. Deductible temporary difference. Okay, taxable temporary difference creates your deferred tax liability. Deductible temporary difference are the temporary differences that result in reduction or deduction of your taxable income in future period when the balance sheet items is recovered or settled. Deductible temporary difference results in deferred tax asset when the tax base of the asset exceeds its carrying value, and in case of liability when the carrying amount of the liability exceeds the tax base. The recognition of deferred tax asset is allowed only to the extent there is a reasonable expectation of future economic profits against the assets or liabilities. To determine the profitability of sufficient future profits for utilization, one needs to consider sufficient taxable temporary difference must exist that are related to the same authority and same taxable entity. The taxable temporary differences that are expected to reverse in the same period as expected for reversal of deductible temporary differences. Taxable and deductible temporary differences. Permanent differences are differences between tax laws and accounting standards that will not be reversed at the some future date. But because they are not reversed at a future date, this difference does not arise to deferred taxes. These items include income or expenses not allowed by tax legislation, tax credits for some expenditure that directly reduce taxes. As an example, is tax credits provided by tax authorities to encourage purchase of solar power or the uh, electric vehicle. Example, in some cases, some jurisdiction says that okay, I will allow you the credit of or tax deduction of 150% of your expense. So this is much more than 50%, 100%. And the residual 50% will never have your reference the financials, but it will be allowed for tax purposes. And when we speak of the tax expenses, the company tax expenses or provision for income tax appears on the income statement and is aggregate of the income tax payable or recoverable and any changes in the deferred tax assets and liabilities. The approach of creating this approach rather than simply reporting income tax paid follows the matching principle by reporting the tax consequences of all current period activities. That's good. Deferred tax assets and liabilities arise from temporary difference in accounting profit and taxable income. Uh, if statutory tax rate change, the recorded value of deferred tax assets and deferred tax liability would also change. For example, assuming a taxing authority reduces the statutory rate from 35% to 21% because the future tax benefit would be reduced because of the reduced tax rate. Because the future tax benefit would be reduced, the recorded amount of deferred tax asset would decrease. Similarly, because the future obligation will also reduce, your corresponding deferred tax liability will also reduce. Now, income tax payable are primarily determined by geographical composition of taxable income and the tax rates in each jurisdiction, but can also be influenced by the nature of business. Some companies benefit from special tax treatment from R&D tax credit, accelerated depreciation of fixed assets. So we discussed these three rates. Differences between the statutory tax rate and effective tax rate can arise for many reasons. Which are they? Tax credits, withholding tax on dividends, adjustment to the previous years, expenses not deductible for tax purpose are among the reasons for differences. Effective tax rate can also differ from companies when companies are active outside the country in which they are domiciled. The effective tax rate becomes a blend of different tax rates of the countries in which activities takes place in relation to the profit generated in each country. If a company reports a high profit in a country with high tax rate and a low profit in a country with low tax rate, the effective tax rate will be weighted average of the rates and a higher the simple average rate for both countries. अगर मैंने सब लोग का सिंपल एवरेज कर लिया तो उससे ज़्यादा हायर रहेगा ये बिकॉज ये वेटेड एवरेज है. In general, an effective tax rate is consistently lower than statutory rates, or in general, an effective tax rate that is consistently lower than statutory rates or effective tax rates reported by competitors is not necessarily unusual but might warrant additional attention when forecasting future tax expense. If your ETR is lower than the statutory tax rate, or if it is lower than the compete, then you need to have an additional attention when forecasting tax expenses of future. The notes in the financial statement should disclose a reconciliation of statutory tax rate to the effective tax rate and identify the items that significantly contribute to the temporarily high or low effective tax rate. Uh, the cash tax rate is used for forecasting cash flows, and the effective tax rate is relevant for projecting earning in the income statement. So, आपके cash flows के लिए you have to use cash tax rate, and for income statement you have to use your effective tax rate. Developing an estimated tax rate for forecast should adjust for one-time event. If the income from equity method investee, if income from equity method investees is substantial part of the pre-tax income and also a volatile component of it, the effective tax rate excluding this amount is likely to be better estimate of future tax cost for the company. The tax impact for income from participation is disclosed in the notes from financial statements. Often, a good starting point for estimating future tax expense is the tax rate based on normalized operating income before the result from associates and special item. So, good starting point for estimating your future tax expense is tax rate based on normal operating income before the result from associates and special items. This normalized tax rates should be a good indication of future tax expenses adjusted for special items in the analyst earnings report. Building a model allows effective tax amount to be found in the profit and loss projections and the cash tax amount on the cash flow statement. The reconciliation between the profit and loss tax amount and the cash flow tax amount should be changed in the deferred tax assets and liabilities. Now, coming to the presentation and disclosures, the consolidated statement of operations and consolidated balance sheet. Fair enough, fair enough. So what all other points? We had seen accounting points, carrying amount, deductible temporary difference, deferred tax assets, deferred tax liabilities, income tax paid, income tax payable. The tax paid is the amount of tax paid, not the provision. Tax payable is the income tax owed by the company on the basis of taxable income. Permanent differences, your taxable income, your taxable temporary differences, which either creates deferred tax assets or tax liability, your tax base, the amount at which assets and liabilities are valued for tax purposes, which would be different from the carrying value of the assets and liabilities, and your tax expense, which is the aggregate of the entity's income tax payable or recoverable in case of tax benefit and changes in deferred tax assets and liabilities. Okay, then comes the next chapter, which is your financial reporting quality, which will be described in the another video.